What's up, friends? Welcome back to the show. Hey, I got a thought for us today from Benjamin Graham's book, The Intelligent Investor. Graham writes, "Thousands of people have tried, and the evidence is clear. The more you trade, the less you keep." That'll be interesting for our conversation today with Justin Cohen. But first, I wanted to tell you this. We want this platform to be about the listener, diving into human performance so that we can help you live at your best. And one of the only ways we can do that is if you hop in the comments below, leave your questions, your ideas, and even your guest recommendations. And we want to address as many of those as possible. And if that's not incentive enough, we're going to give away a free Apple Watch. That's right. All you have to do is subscribe, put your name in the drawing, and the winner will be announced during our 5th episode. Super exciting. Want to give back and give a token of appreciation to our early supporters, our early subscribers. Super cool. So what the heck is going on in the market? Seems like everybody picked up the hobby of day trading during the pandemic. And honestly, the Robinhood fiasco, GameStop, the fluctuations, the printing of money by the U.S. Treasury, all of these things have created a really rowdy and crazy climate. So I thought, heck, I'm going to bring in one of the smarter guys I know on this. Dear friend of mine, Justin Cohen. He's a member of the investment team at the Boston Children's Hospital, a graduate of the University of Notre Dame, husband, and honestly, probably one of the smartest guys I know. Hope you guys love this conversation. Let's get it rolling. Ladies and gentlemen, Justin Cohen, welcome to the podcast.
Appreciate that,
dude. Thanks for hopping on today, man. You're my financial guru. You're my go-to guy.
All right, I love that.
Let's go ahead and get the disclaimer out of the way, right?
I wrote this down.
Okay, go for it.
Number one, all opinions that we express on this podcast are solely our opinions. We may maintain positions in the securities that we mentioned and discuss. And lastly, this conversation is for informational purposes only. It should not be construed as investment advice.
For informational and educational purposes. This is fantastic. All right, for the listeners, Justin's very humble. Dude was like a 4.0 in finance at ND. Very, very smart guy. I think got a perfect score on the ACT. SET was darn near perfect as well. The guy's brilliant nonetheless. And I think it's very, very important to talk about money, Justin, because a lot of people have different relationships with money. Some of us grew up without money. Some of us grew up with money. And whether you have money or don't have money, the relationship and the way in which you see money is very, very important. I read an article actually 10 years ago. Forbes posted this, and it was a Wall Street investor who referenced the Bible and was like, the Bible mentions money 800 times and references money and possessions 2,000 times in total. And so I think our relationship and the way in which we handle it is important to understanding how to be the best human being that we can be. And so I don't know, what would you describe as a healthy relationship with money? Maybe even culturally, what do you think our relationship is with money right now, and where should it and can it go from here?
Yeah, wow, it's
a heavy question.
That's a heavy question.
We like to ask deep questions.
That's the only kind of questions that are worth asking. Yeah, I would say that question of what is a healthy relationship with money and what does it look like to use whatever resources you're given well has been something that for the past 2.5 years since I've graduated, I've been ruminating on, I've been journaling on, thinking through, because at the end of the day, we're spending almost all of our waking hours in our vocations of some sort, whether that's in a role in a finance firm, an investing firm, whether it's as an athlete, and the fruits of our labor for our vocations is money for the most part, right? There's obviously other aspects there. And so it's something that I think a lot of folks shy away from because it is complicated, it's messy, it is confusing and scary. I mean, well, as we'll talk about, I'm assuming on this podcast, the same folks that were riding the wave up have also in some ways ridden the wave down. And, you know, some of those amounts were probably life-changing on both directions. And so the simple way that I've tried to frame my relationship with money, and I would say this is a newer development, has been, how can I be a faithful steward of what I'm given? And it's simple. I think whether that's stewardship in my family, my wife and I, whether it's stewarding the assets that are entrusted to our team in my role, or whether it's just helping out folks that need not even advice, but just a framework for money. That's been a big part of my journey, I would say, in the finance world so far.
Do you think there's any universal takeaways from, you know, regardless if you have money or you don't have money, that there are universal aspects to our mentality and how we should view money?
I mean, one piece of, I guess I would say, universal wisdom that I've taken both from, you know, you mentioned as we read scripture, but also just in secular worlds, is starting early. So I've heard a really interesting concept where instead of giving, let's say, stimulus or any sort of other payments later on in someone's life, if we were to provide, let's say, like an ETF or something super low cost, an index fund to every child at birth in the US, let's say it was $1,000, it's a modest amount of money, but over 18 years, it grew at the same yearly rate as the general stock market, about 10%. By the time they turn 18, that would be over $5,000. And if you were to keep that and add no money, just let it grow untouched, by the age of like 32, you have, I think, over 20 grand. And that's starting $1,000. That's super early.
So that is fascinating.
Yeah. I mean, the compound interest is the eighth wonder of the world. Like there's just this notion that if you start early, even if you pick the wrong investment and you time it wrong, you get in right before a crash, like you're still going to be so much better off over the entire spectrum of your life.
I heard going throughout this past presidential cycle, Andrew Yang actually proposed, I think, a universal basic income policy. And I don't care whether you agree with Andrew Yang or not. It's a fascinating concept if you actually look into it. He proposed that regardless of what your net worth is, what your upbringing is, everyone starting at 18 years of age receives, call it $1,000 or $1,200, it might have been, annually. But I think this is a more interesting idea, right? If you're born a US citizen, if you're born, you know, here in America, you get $1,000 in an ETF, call it whatever, a fund, but it is set up. And instead of having to give somebody $1,200 a year, you give them $1,200 at birth, and you allow compound interest to grow to where you talked about at 30, it's sitting at 20K. I think a lot of issues, mid 20-year-olds, even early 30-year-olds, is they're still trying to pay off their student debt. Student debt is huge. I mean, my family, like my brother's going through that right now. They're trying to pay off student debt. Like even getting our education, yeah, it's a great investment, but it also puts you in the hole a little bit if you don't get a scholarship, if you know, your parents aren't able to pay for it, it puts you in the hole a little bit. That's a fascinating idea.
It's certainly not my own. I'm sure I co-opted it from a podcaster. I've this year been listening to so many different folks talk about how do we basically steward assets well, both as people in the U.S., but also just as like, you know, folks within society that have been given that opportunity. So I think where it differs, right? Like at the age of 18, if you're given $1,200 a year, like that's a lot of money. That's rent or food or all these things, but it addresses maybe that first question of income, where for that year, your needs are provided for, you're kind of getting out of the hole. But how do we think beyond like the 1 year time horizon to say, how do we build wealth rather than, you know, how do we almost like provide for the daily needs when those things should be met anyways? It's not like we should neglect those. Those shouldn't be what's driving the larger investing conversation, I think.
Have you heard of Acorns?
Love Acorns. Yeah. Tell us about the premise of that.
Well, I mean, you probably know better than me, but the idea that acorns can grow into big trees, right? And I think the idea is you have a credit card, you have, you have some type of card, call it credit, debit, whatever, and you make a purchase. Let's say you buy coffee at Starbucks for, I don't know what they're going for now, a latte, venti latte
$3,
for
$4.
472. Well, the additional 28 cents would go directly to your Acorns account and be invested kind of instantaneously or simultaneously and thus grow. And so it's this idea of, I think it rounds up to every dollar. You can set it on however you want, and you can set limits on it. So if you only want to invest 10, $100 a month, you can do that. And I think it's a really cool concept because people don't have to think about it. All they have to do is download this app, link up their account, and this stuff is happening instantaneously. It's a really, really cool concept. And I think you're seeing, more of an interest as this discussion becomes more prominent in the national eye, this idea of, income equality, financial literacy. You're seeing these apps like Robinhood and like Acorns now who are trying to make it more accessible to the retail investor. And it seems like there's a rise in retail investors. And so I think Acorns is a solid idea. Acorns should sponsor this episode. I just give them a massive plug.
Go out to them. Yeah. I wonder if they'll have 600,000 downloads like Robinhood did last Friday. But the difference between those two platforms, and again, we don't have to get into specifics, but what Acorns is encouraging is it's trying to get you invested as low barrier as possible. So you don't even need to think about it. And as early as possible. So like you don't have to each month go into your Fidelity or your Robinhood account and say, I'm going to put $1,000 there, because that's a daunting task and that's a lot of money and it requires a lot of steps in that process.
Barriers to entry, yeah.
Totally. So removing barriers, and you could use the word democratizing, you could use the word like accessibilizing. It's probably not even a word, but is I think what a lot of these new or probably 5 to 10-year-old fintech startups have been doing, and with reasonably high levels of success.
Hey, if you want to listen to today's full show, you can do that by going to Spotify, Apple Podcasts, or wherever you do podcasts. Thanks so much for listening. That's a wrap.